Alrighty. So today's video, we're going to be talking about the bid-ask spread. All right, we're going to learn how to use the bid-ask spread to your advantage so you can get better fuel prices, and more importantly, not to let the bid-ask spread take advantage of you. All right, so what exactly is the bid-ask spread? So you can see down here, we have two boxes down here. So most of the time when you look at your bid-ask spread, or when you look at the bid and ask on your trading platform, a lot of the times you will see that it's coded in red and the ask is coded in green, and that is because this is what the broker is trying to tell you, that if you want to sell, you want to hit the bid, and if you want to buy, you want to hit the ask. So the bid essentially is the highest price that the market is willing to buy from you at that point of time. So that is why if you want to sell, most of the time, right, you would go ahead and hit the bid. That's what it's called. You hit the bid, and then you will be able to sell at this price down here. And on the other hand, the ask is the lowest price that the market is willing to sell to you at that point in time. So if you were to hit this ask button, you'll be buying at this price of $20.20 immediately at that point in time. Now, the difference between these two prices, the bid and ask, is what you call the spread. So the spread basically also indicates, right, the liquidity, right, how liquid this product is. So if the spread is wide, then you will know that there is not that many market participants inside, right? The wider the spread is, it means the more illiquid the product is. But the tighter the spread is, that means that there's more market participants, which also means that you can get a better fill price. Now, the thing I want you to take note of is that although the bid, it says that this is the highest price that the market is willing to buy from you at the time, right? The thing is that the bid is usually the worst price that you can actually sell at, right? And the ask is also usually the worst price that you can buy at, because this is what you call buying at market, right? You're just taking whatever the price is that the market is willing to give you, right? So instead of just buying at the ask or selling at the bid, instead what we want to do is to place our orders in between the bid-ask spread, because you can see that although this spread is 20 cents, right, if you were to buy many shares or many contracts, this can easily add up, right? So if there's one option contract, right, 20 cents would equal to a $20 difference, right? So if you were to just buy and sell at market, if to buy at market and sell at market, you will immediately, right, lose this $20 in terms of the spread. So instead of always just buying at a bid and ask spread, we don't want to do that. We want to always queue our orders in between the bid and ask spread if you want to get a better price than what the market is willing to offer. The next thing I want you to take a note of is this color down here, this number down here. So this number, two number down here, is the size. You'll notice that whenever you open up your platform, you see the bid and ask price down here. At the side, you always see a number, right? Sometimes they will say this is the BS, and this will say is the AS, right? What this is basically the size, right? Size, that means if this is the shares, then there'll be 25 shares here. That means there are 25 shares that wants to buy at this $20 price, and down here is 45 shares that's being queued to sell at $20.20. Now, there are people out there that are saying that this is the number of people that want to buy at $20. Now, that is not right. Right? This does not represent how many people. It doesn't say that there's 25 people. No, it says it's just 25 shares. Now, these 25 shares could be, 25 people, it could be 10 people, or it could just be one person. So it does not show it down here, because this is just the level 1 quote, right? We call this level 1 quote. Basically, it's just saying the best bid price and the best ask price. Okay, so this is one thing you want to take note of. So the whole thing about how this bid-ask spread works, or how this stock market works, is that it is actually a giant auction house. All right. So if you are not familiar how the auction works, so basically this is where people will bid to go ahead to buy, the certain stuff that they want. Let's say there's a painting that they want to buy, they will always bid to buy it. Right. So this is basically pretty much like how the auction house works. So all these prices down here, and all this number of shares that people want to buy, or in terms of options, this number of contracts that people are queuing to buy at the prices, this is what the market is trying to tell you that they are willing to buy or sell for this underlying stock or for the option. So down here, this is what you call the level 2. So level 2 just shows the other bid prices and all the other ask prices. So for example, if you want to, let's say you want to buy this stock down here, right? Let's say you think that, I don't mind buying at $20, but you do not want to pay for $20.20, right? So let's just say you're willing to only buy at $20. So what you do is you might be saying, I want to buy 10 shares. So if you want to buy 10 shares, what you do is if you enter your order for $20 for 10 shares, this is what will happen, right? This, instead of 25, will now show 35, because right now, this includes the size of the shares that you want to buy at this price. Okay, so now the next thing you want to understand is this, right? So there is a queue system going on. That means like you are queuing, right? If you want to buy something at the stall, you have to queue, and if the first person haven't bought his stuff yet, it's not your turn yet. You cannot buy it. So it's the same thing. So for example, if somebody was to come and hit the bid button, that means they want to sell the stock, which means that you get to buy it. So let's say if somebody wants to sell 10 shares, right? 10 shares at $20, they hit the bid button. Do you get filled? Well, the answer is no, you do not get filled because you are at the back of the queue, right? So what happens is that this 35, the first 10 shares is gone. So that means the first person who was there before you would have gotten their shares bought, right? So they have bought the 10 shares, and now you are still at the back of the queue, right, at the 25. So the only way that you can buy your 10 shares is if somebody comes in, or ultimately many people come in to buy out all this number of shares here. So if the next person that comes in and says that, hey, he wants to sell 30 shares at $20, what will happen is that he will take out all these people down here. So there no longer is anybody queuing at $20, and what happens is that he will now have 5 shares, right, left over to buy at $20. So what happens then? So now the bid of $20 becomes the ask. So now this $20 no longer becomes here, because now he is on the ask side. So now he is showing a $20 here with a size of 5 shares, right? And then what happens to this $20.20? This does not become the best ask anymore. What happens is that this will go down, including the size will go, as in it will be queuing down here, and right now the top of the ask, right, the best ask price will be that person who is wanting to sell 5 shares at $20. So this is how prices move. The way price moves is because of size, right? Size moves the market. That is why if there's a person that's coming in to say he want to sell 1,000 shares, right? If imagine he says he want to sell 1,000 shares at market, which means to say he doesn't care what price he gets. He just want to sell 1,000 shares right now. So if you were to add up all the shares down here, right, and it doesn't equal to 1,000 shares, what happens is that he will take out all these prices. He will sweep all this price until the 1,000 shares get filled up, and then that will become the new ask price. So that is how you see the price can immediately tank, right? So during a crash, this is what happens. People just want to get out of the market immediately. If they want to get out of the market immediately, they hit the bid button. They just sell at whatever the market is giving them because they are afraid the market will drop further. So whenever they're hitting this, they're just taking out everybody on this side. And on the other hand, because the market is dropping and crashing, a lot of people also do not want to buy into the stock when it's crashing. So you will notice that as the market is dropping, a lot of this size becomes smaller, because lesser people are willing to buy the stock. But then on the other hand, you will see this number starts to increase. Maybe this becomes 380, this becomes 290, and it becomes bigger because now a lot of people are trying to get out of their stock. They want to quickly sell. So what they do is that they will queue such a big order, and there'll be very little people on the buy side, or rather there's very little volume in terms of buying. That's how the market can really crash very quickly. Now, on the other hand, if the market was to go up, it's the same thing as well, right? So let's say, for example, you want to buy a stock, right? You want to buy 100 shares at $20.20. So same thing, if you were to buy 100 shares, what will happen? you will take out all this 45 shares, and then you will have leftover of 55 shares, right? So what happened is that this will now go down to the next best bid, and your bid now becomes the best. Your bid becomes the best because you want to buy at $20.20, and then you still have a size left over of how many? 55. And then on this side, this now becomes the best ask, right? So now this will go up here, and that is how the market moves. So this is always happening back and forth, up and down all the time. So when it comes to trading options, it's very important to understand where you want to get filled, because the last thing you want to do is get a bad price. On this platform, which I'm using for my broker, which is the TD Ameritrade, which is Thinkorswim, whenever I buy the call option, I'm not sure is it the default order or what, or the settings that I didn't change, but whenever I want to buy an option, let's say on this 129 strike, you will notice that it always populates the ask price, right? This is the ask price which you buy. So this is the best price that the market is willing to sell to you, but it's also the worst price that I can get, right? On the other hand, for the when I want to sell an option as well, you can see I sell the call option, it immediately populates 1.98. So again, this is the worst price for me as the option buyer or the option seller. I never want to buy at the bid or the ask. So instead, what I want to do is I always want to take a look at this mid price, right? This mark price. This mark price is essentially the mid price between the spread down here. So I always want to take this mark price as an indication of where I want to get filled, right? So what I want to do is when I enter the order, I never want to just enter it as the ask, but rather I will adjust it to the mark price. And if I'm buying the option, right, if I'm buying an option, whether it's a spread or is it just a single option, I will ensure that I always buy a few cents below the mark, because sometimes you will find that you can get filled before the mark price, right, below the mark price. And if I want to sell an option, whether is it a spread or a single option, what I'll do is I'll place an order above the mark price. So if the mark price is 2.04, maybe I'll do something like 2.06, 2.07. Right, definitely not more than 2.10, and then I will enter the order and see whether I get filled, right? If I don't get filled, I will keep reducing or increasing the price. So if I'm buying the option, if I queue at 2.02, I don't get filled, I just wait like 1-2 seconds, I know I don't get filled, I will quickly adjust the price again. I'll adjust it up by a few cents, depending on how wide the spread is, right? So if this is a very tight spread, I might just increase by 1-2 cents. But if the spread is very wide like this, you can see this is $8.40 and $8.80. So there's 40 cents in between. So this is a $40 difference, right? So if you were to just immediately buy at the ask or sell at a bid, you'll be losing out $40 on this. So I will take a look at the mark. And then in this case, I probably will adjust every 5 cents or so, every 5 cents to every 10 cents if I don't get filled. So again, if I'm buying the option, I always want to place my order a few cents below the mark price. And if I'm selling an option, then I want to place the order a few cents above the mark price. All right. So let's have some takeaways. So the first thing is that the bid is the highest price that the market is willing to buy from you. That means if you want to sell, you're looking at the bid price, right? And then the ask is the lowest price that the market is willing to sell to you. So most of the time, if you want to buy, you're looking at the ask price. But then again, we already know that the bid and ask price is always the worst price for us. Okay, so we never want to buy at the bid or the ask, or buy or sell at the bid and ask price. Now, the next thing to understand is that the market is a giant auction house, right? So how the prices moves based on where you queue in the order and how what's the size of your order. That's what moves the market, all right? Not the number of buyers and sellers. And again, the tighter the bid and ask spread, the more liquid the stock option is. So if you want to get the best option fill price, all right, so when you're buying the option, what you want to do is enter your order below the mark price, and when you're selling options, you will always enter your order above the mark price, and then you will adjust a few cents, right, either up or down depending whether you're buying or selling the option. So this is what you call price discovery. So anytime when you want to buy or sell options, always utilize price discovery rather than get at the the readily available price that's given to you by the bid and ask. All right, guys, so I hope this video has been helpful to you, and if it has, I'd appreciate it if you hit the subscribe button and also give a thumbs up so I can create more videos like this for you in the future. And as always, thank you for watching. I appreciate your time, and may the options favor you.